Okay, so if you've spent any time, really any time, looking at the markets lately, maybe just checking your phone or digging into analyst reports, you know the feeling. We're kind of navigating this really volatile financial environment. And maybe worse, we feel like we're drowning in data. Just the sheer volume of news, commentary, analysis, it can feel overwhelming.
Yeah.
So our mission today is maybe a shortcut to some serenity. We're taking all this material you share, the research memos, technical papers, those behavioral studies, and we're trying to find a clear path through all that financial noise. We're looking for the tools, the ways to spot genuine opportunities amongst all the constant chatter.
Exactly. And for you listening, the goal isn't just piling up more information. It's about cultivating a deeper, almost, well, serene understanding of how markets actually work. We want to help you maybe stop that cycle of, impulsive reactive trading and move towards making decisions that are informed, rational, and ultimately feel calm. That process. That's what we mean by seeking clarity in chaos.
Okay, clarity in chaos. I like that. Let's unpack this then. Maybe starting with the fundamental problem that comes up again and again in the sources.
Right.
Why most of what hits our screens every single day is basically just noise, and how that noise sets this terrible trap for us.
So the core issue today isn't really a lack of access to information, right? It's the sheer volume. The sources you provided really highlight this kind of data paradox. The more data we seem to consume, the less clarity we actually get. It's almost paralyzing because every little piece of data feels like it demands our attention now.
And that volume, well, it carries a pretty significant psychological cost, those constant updates. They seem almost perfectly engineered to fuel that fear of missing out, the FOMO trap.
FOMO, yeah.
When you're just bombarded by every market fluctuation or you see this relentless hype about some potential moonshot stock, it just bypasses your rational thinking. The data actually shows that traders who are operating in these high FOMO environments, they increase their transaction frequency by up to 40%.
Wow, 40%. Yeah. Which basically guarantees they're trading based on emotion, not on whatever strategy they might have had beforehand.
That statistic on transaction frequency, that really hits home. So if the data is like this tsunami designed to make us panic, then the essential skill we need to develop right away isn't finding more data. It's figuring out the signal versus the noise, right? What piece of information truly impacts the fundamental value of what you hold and what's just, well, designed to grab and monetize your attention.
Distinguishing between those two isn't just like a useful skill. It's really the foundation of resilience for an investor. If you fail to filter out that noise, you can just never stick to a consistent strategy. You end up becoming sort of a permanent tourist in the market, just reacting to every single bump in the road.
Okay, so let's look at two major sources of that external noise: media coverage and those analyst calls. When the media covers a market event, how does that typical media bias and, let's be honest, sensationalism, how does that frame the news we consume? And how should we filter it?
Well, sensationalism, you have to remember, it's a business model.
Right, clicks and eyeballs.
Exactly. The sources point out that news outlets are fundamentally incentivized to present information in the most dramatic way possible, because that's what drives engagement. For example, the data you shared suggests that headlines using fear-based language words like crash, plunge, or doom, they get click-through rates about 30% higher than neutral reporting.
30%. Even if the actual market move is identical.
Even if the underlying change is exactly the same. So a market dip isn't just a correction in the headlines. It's often framed as plunge, which just ramps up anxiety and encourages really short-sighted actions from people.
And speaking of anxiety, everyone watches for those big analyst upgrades and downgrades. They feel so official, like these immediate decrees coming down from Wall Street. What's the disconnect between how important they feel and their actual long-term influence?
Yeah, it's often a big perception gap. I mean, sure, an upgrade can definitely cause a momentary price spike, no doubt. But the market often preemptively factors in a lot of that information long before the report is even published. It's that classic scenario, buy the rumor, sell the news. Right. So basing a long-term investment decision purely on a single analyst call often just forces you back into that reactive FOMO state because it gives this false sense of having complete, timely knowledge.
And that's the connection we need to make really clear, isn't it? These external signals, whether it's sensational media or these urgent-seeming analyst calls, they feed right into that trap of the illusion of control.
Precisely. The illusion of control. It's that cognitive bias, that error that makes us believe that just because we're aware of every tiny market movement and every single headline, we can somehow predict and, well, control our financial outcomes. The reality, as your sources consistently emphasize, is that trying to react to every single headline, it's just defined as a losing
A
game.
losing game. Okay.
Yeah, you're simply increasing your transaction costs, you're introducing massive volatility into your own returns, and ultimately, you're trading against your own long-term strategy. Recognizing that we can't control the market, only our reaction to it, that's a crucial, sometimes painful step towards building real resilience.
Okay, so we've established a danger of sort of passive noise from media and analysis. Now let's pivot to something more active, deception. One of the most, frankly, alarming things in the material you shared was the section on active manipulation. What are the key red flags the sources highlight that listeners should really watch out for?
Yeah, we absolutely have to talk about recognizing the red flags of these coordinated manipulation schemes. These aren't just differing opinions, these are deliberate attempts to profit by actively misleading you. The most common scheme detailed in your stack, and it's a classic, is the pump and dump.
Ah, the pump and dump.
Right. This is where manipulators artificially inflate the price of a security, usually something like a low float illiquid stock using false or misleading statements. They create intense hype.
Get everyone excited.
Exactly. Only to then sell off their own shares, which they bought cheaply beforehand, right at the peak price, leaving everyone else holding the bag.
Can you give us an example? Like what kind of language should immediately set off alarm bells?
Certainly. One anecdote detailed in the source material described manipulators promising things like a guaranteed 10x return by Tuesday.
Guaranteed 10x by Tuesday.
Wow. Or claiming a stock was, quote, undiscovered by Wall Street but poised for immediate liftoff. That kind of hyperbole, that urgency, that should immediately trigger your internal red flag filter. If it sounds way too good to be true, it's almost certainly designed to exploit your FOMO.
Makes sense. We also need to look at institutional movements.
Hmm.
We hear about whale movements, these large institutional plays. How do we analyze that? How do we separate informed action from just simple hype when the transaction sizes are so enormous?
Whale movements are complex, primarily because they are often not short-term trading signals, even though they might look like it sometimes. Institutions typically operate on multi-quarter or even multi-year time horizons. What we need to look for are signs of accumulation versus distribution.
Accumulation versus distribution.
Right.
All right.
So, an institution might spend months quietly accumulating a massive position, maybe using dark pools or off-exchange transactions. That's the informed action happening under the radar. Retail traders often misinterpret maybe smaller, later movements as the start of some short-term rally, when actually the smart money has already been building that position for maybe half a year. They mistake a foundation-building move for fleeting hype.
And all of this difficulty, this complexity, it's just compounded by the modern challenge.
Yeah.
Social media's amplifying effect. Right?
Oh, absolutely. Social media has basically put the pump and dump scheme on steroids. Online narratives can distort reality incredibly quickly because the platforms prioritize speed and consensus over accuracy.
Yeah, things go viral so fast.
Exactly. A handful of motivated, maybe organized individuals can create this feedback loop of excitement that becomes completely detached from any fundamental value the asset might have or not have. When investment decisions start being based on which direction a social media herd happens to be stampeding, rather than on actual fundamental research, well, you're walking directly into the chaos we're talking about.
All right, so we've identified the noise, the manipulators. What does this all mean for our actual practical strategy? We clearly need a defense strategy, one that's built internally, not relying on external cues. The first step the material really emphasizes is defining your investment philosophy. Why is sticking to your principles, especially amidst volatility, so absolutely vital?
Because without clear, defined principles, things like your non-negotiable risk tolerance, your target asset allocation, your minimum time horizon, without those, every single piece of market noise sounds equally compelling and equally dangerous. Your philosophy acts as your anchor when the storm inevitably hits. When volatility strikes, the idea is you don't panic, you go back, you check your principles, and you execute the plan you already made.
Okay, that sounds great in theory. But let's be real. When the market is down 15% in a single week, and your principles are telling you to just hold tight, how do you manage that powerful behavioral urge to just sell everything? What's the practical tool you use to overcome that gut reaction?
That's precisely where we emphasize the power of patience and the concept of having a long-term vision. That long-term vision is the practical counter-tool to short-term panic. The sources you provided really underscore this. If your investment horizon is, say, 10 years, then a bad headline today is ultimately just noise in that context.
A blip.
Exactly. But if you're reacting week to week or even day to day, then every single headline becomes a potential catastrophe in your mind. Patience really means measuring your success not by today's closing price, but by the progress you're making toward your multi-year goal.
Which brings us to what might be the most counterintuitive, but maybe the most essential finding in this whole deep dive: strategic inaction.
This is huge, a massive takeaway for you, the listener. In a really noisy environment, doing something, any action, it feels productive, doesn't it?
Yeah, it feels like you're taking control.
Right. But often it's actually detrimental. When the market is reacting violently to rumors or fear or outright manipulation, the data actually confirms that doing nothing is often the smartest move you can possibly make. Think about that classic scenario during the 2008 financial panic. An investor who just held on to a passively managed index fund, yeah, they had to endure a significant paper loss. It felt awful, I'm sure. But they preserved their capital fundamentally and participated fully in the subsequent recovery. Now, compare that to an active trader who may be strategically sold based on headlines and rumors. They likely crystallized those losses at the bottom, probably missed the early stages of the recovery, and ended up getting whipsawed back and forth, racking up significant transaction costs along the way. Strategic inaction conserves your capital, it helps you avoid those costly behavioral mistakes, and it allows the true signal, the fundamental value, to eventually emerge once all the emotional noise dies down.
Okay, now we're getting to the really practical stuff. We're ready for the final steps. How do we actually operationalize this sense of calm and put it into practice day to day? You mentioned we need to develop our own personalized market filter. What does that actually mean?
Yeah, the market filter is essential because it kind of externalizes your rules. It makes them concrete. It's basically a set of pre-agreed tools and techniques for filtering out noise that's specific to your philosophy. And your sources suggest some very actionable steps here. For instance, maybe limiting your market review to just end-of-week closing prices instead of checking hourly on your phone.
Ooh, that's a tough one for some people.
It is. Or adopting, say, a mute list for any commentator or publication that you notice repeatedly uses that hyperbolic, fear-driven language we talked about. Another technique suggested is deliberately only reading reports from a select few, maybe pre-vetted research outlets you trust, and specifically excluding anything labeled as a hot stock recommendation.
Okay, so this filter, it supports what seems like the most critical skill identified in all the material: independent thought. It really means trusting your research.
Yeah.
The research that aligns with your defined philosophy. Trusting that over basically every external voice, whether it's a respected analyst on TV or some viral account on social media.
Absolutely. External voices, they can provide context, sure, but they must never provide the command. Superior returns consistently are achieved when you conduct your own due diligence, you form a rational hypothesis based on that, and you stick to it. Not when you're just chasing the latest trend or panicking based on the daily news cycle. This synthesis of resilience, strategic inaction, patience, and independent thought. This is how we learn to truly embrace the calm. And that calm, quite directly, the evidence suggests, leads to superior, more consistent returns over time.
The serenity of a clear mind actually paying better dividends than the frantic energy of the reactive trader. That's a powerful data-backed conclusion to land on.
Yeah.
Hashtag tag tag outro. Wow.
This has been a really critical deep dive, I think. We moved from recognizing that FOMO trap, fueled by just data overload, through identifying active manipulators and the biases baked into media, and we landed firmly on the power of strategic inaction, backed by a really well-defined investment philosophy. It seems the path to serene decision-making requires this conscious, sustained effort to just tune out the static. And that effort, it really starts right now for you listening. If strategic inaction and independent thought are truly key, maybe consider this final question for some deeper exploration. What are the core, truly unshakable principles within your own investment philosophy that you might currently be allowing that illusion of control, that constant need to react to, undermine? Take some time, maybe later today or this week, to identify the gaps between your stated philosophy and your actual behavior in the market. The answer to that question, that's where your clarity truly begins.
Food for thought indeed. Until the next deep dive, stay informed, and maybe most importantly, try to stay calm.